Hello, everyone. Welcome to our latest quarterly market update and review. I'm Jeff Sarti, CEO of Morton Wealth.
And I'm Meghan Pinchuk, Chief Investment Officer.
We're going to cover a number of things today.
Yep, big agenda.
First question that's top of mind is, what direction is the economy headed? Are we going into a recession or not? We're also going to talk a lot about inflation. That's obviously been top of mind, a lot of volatility around the inflation numbers. And then finally, we're going to talk about our various investments. How are they doing, and what is our outlook going forward? So I'm going to start with the first question, the economy. Again, top of mind, in the headlines. Punchline is, are we going into a recession or not? What are your thoughts on that?
I think this is probably one of the most predicted recessions on record, where for a long time people have thought that we were going to go into a recession, and it's maybe taking longer than some thought. But there are a lot of positives and negatives out there that are making it more confusing. We're getting mixed signals of some things saying, yes, recession's coming, others saying, no, maybe the economy's doing okay. So starting with one is just the labor market. The labor market continues to be really strong, so unemployment very low. Inflation has also been really a positive, where it was quite high. It got all the way up to 8%. We're going to go through that in a little more detail later. And it's come down now pretty meaningfully. Consumer spending is a big deal. So the consumer spending actually accounts for about 70% of the economy. So the consumer has continued to be very strong in this environment. And then finally, one thing that a lot of people, I think, don't look at, it's a little more under the radar stat that we're pretty focused on, is fiscal spending. So what do I mean by that? The Fed, with what they're doing with interest rates and such, that's more monetary, the monetary side of things, the control of the money supply. Fiscal is more Congress and our federal government and how much they're spending. So those deficits, our annual deficits, how much they are spending, have now gotten up to over $2 trillion again. Peaked at somewhere above $4 trillion during COVID.
During COVID, yeah.
Yeah, that was pretty epic. And then now, though, it came back somewhat, but now we're back to extremely high spending levels. So think of that as just a injection straight into the economy to a large degree. So in a lot of ways, even though there are drags and weaknesses, I think that piece of it in particular has, to date at least, really supported the economy and kept us from going into recession.
So you listed a lot of positives. Now I'm going to maybe shift gears and list some of the negatives.
I'm the positive one?
You're the positive
I'm the positive one.
So starting with the Federal Reserve, you hit on this a little bit. Partly because of the positive data we're seeing, the Fed is continuing to raise interest rates. Today, as we're filming this, it's Tuesday, July 25th. The Fed is meeting tomorrow, and the odds are that they'll likely raise again by another quarter point. And we don't really know at what point these higher these higher interest rates are going to start to choke the economy, going to slow things down.
We do know it's the fastest rate hike cycle on record, so they've been quick and they've been aggressive about it.
They've been very aggressive, but again, to date, hasn't quite caused a recession, which has caught a lot of people by surprise. Manufacturing data has really been a tremendous downturn. 8 months in a row of manufacturing contraction, which is pretty unprecedented to have that without having a recession. One other point that we hit on last quarter's market review, banks. Banks are tightening. You had a lot of comments last quarter about Silicon Valley Bank and Signature Bank, and how regional banks are really retrenching.
Yeah, they had a lot of issues to work through.
A lot of issues, and they're really tightening the screws, and they're not lending as much as they were just previously. So coupled with the Fed tightening and the bank lending, credit conditions have really tightened. And the last thing I'll just comment on is corporate earnings. Corporate earnings are really flat year over year. We're not quite in an earnings recession, but as go corporations, so goes the economy. And again, it's been sort of flat in terms of earnings growth over the last year or so.
So pros and cons.
Pros and cons on both sides.
Bit of a mixed bag.
So all that being said, we are watching a few specific data points more closely than others. Let's go back to inflation. Can you do a little bit of a recap of where we've come from in terms of inflation over the last 3 years and potentially where we're going?
Yeah, because inflation, so for many, many years, was extremely low. You know, it was at or below even the Fed's target 2% rate. Yeah. And then we started to see it rise in 2020, and then it peaked in 2022 at 8%.
8%, yeah.
So that was when it was huge in the headlines. Everyone, very worried about it and how sticky it's going to be. And since then, today, it's now come down to about 3%. So it's definitely come down pretty meaningfully. But the Fed is still, I think, very cautious about it. And the reason for that is that inflation is one of the most destructive things for an economy. So there's a lot of focus still on, even though 3% is much better than 8%, it's still also a far cry from the 2% target that they would like.
Yeah, one other point on this. While it's beneficial and nice that inflation did come down from 8% to 3%, keep in mind, inflation has been running hot now for 3 years,
Yeah.
3+ years. So 3%, that's just over the last 12 months. When you think cumulatively over the last, call it 3 years, prices in some segments of the economy are up 20, 30, even 40%. Think about groceries, you think about restaurants. I go out to dinner with my family, the restaurant bills are through the roof.
Yeah.
Services, hotels, Taylor Swift concerts, for all you Swifties out there. You were a Swiftie at one point.
My daughter's not old enough yet.
So, I mean, just the cumulative run up on these prices is pretty extreme in some areas.
I've been to it's interesting to think about. We've set a new floor. So that's the context that people have to take this in. It's not just, oh, look, inflation is down. That doesn't mean it's negative. That doesn't mean prices are retrenching. It means that you've had this new floor, and now the growth rate from there is slower.
Right.
So a great example actually is that we invest with a company that makes loans to food companies, and they had a really tough time in 2020 because all their costs, their raw materials, were going through the roof. Eggs and flour, sugar, all those things were really expensive. They had to raise their prices, and so they did. They did that to maintain their profitability. But now a lot of those input costs have moderated. They're not all the way back down, but they've really come down meaningfully from their peaks. But it's not like the companies are lowering their prices.
Yeah.
They're going to keep them where they are. So the consumer is going to continue to pay those higher prices. That floor has been set.
Got it. So, all right. So a lot of moving parts with regards to inflation. Somewhat tied to that, now, second data point we're really looking at is the labor market.
Yes.
Labor market has remained strong, as you hit on. But one of the concerns with a strong labor market is wage pressures. And we are seeing wage pressures. They haven't quite gotten out of control yet, but that's something that the Federal Reserve and those who are concerned about inflation are looking at.
Yeah. And if you look at the data for about the past 20 years, what you see is that typically what's normal is that you have more people looking for jobs than there are job openings. So that's a pretty consistent trend, sometimes a wide gap in that direction. And so now what you've seen is post-COVID, you've got the reverse happening, where the number of people looking for jobs is meaningfully lower than the number of job openings that are out there. So there's an imbalance now. And the problem with that gap is that what does it do in terms of wage pressures? Can it create a spiral where companies need to compete for fewer workers?
Right.
And so do they raise what they're paying, their salaries? And does that create a lot of pressure on inflation? Good for the economy, potentially short term, right? Supporting the consumer, but again, from an inflationary standpoint, it is something to watch.
Now, tying the labor market with consumer spending. Consumer spending has stayed relatively strong. And again, one of the big reasons is because employment has remained strong. Unemployment is low.
Yeah.
But when you kind of peel back the onion and look beneath the surface, there are other factors as well that are supporting consumer spending that are a little bit more concerning.
Yes.
Can you talk about those a little bit as well?
It actually would be a good thing if it was just from employment
Yeah.
and the consumer were strong and healthy, it would be different. But we are starting to see signs of weakness with the consumer. So there's a chart we're going to show that has the savings rate, so the household savings rates. And what you can see on this is that in 2007, we reached a low of savings. Post the financial crisis, 2008, savings started ticking back up. And then you get an explosion of savings during COVID when people got all their stimulus
checks, right, from the federal government.
So people, they started saving, they kept that cash. But now you can see also an aggressive downward slope where now we are back from a savings standpoint, back toward those 2007 lows. So the consumer is not just healthy from spending their earnings, they're also spending through their savings rate. One other data point is that credit card debt is also exploding. So credit card balances are up meaningfully year over year, and that I think is also adding to the consumer spending that's out there, but it's creating not necessarily a sustainable balance for that consumer.
So that's concerning, right? I mean, low unemployment's great, but on the flip side, consumers pulling from spending, binging on credit card debt, that is not sustainable over the long run.
Right, absolutely. So just to recap, those key data points that we're focused on. So it is we're watching inflation, we're watching the labor market, and we're watching the health of the consumer. So there are other things out there and lots of pros and cons, but I think those are, if we had to pick three things that we're probably the most focused on economically.
Let's shift gears and talk about various investment asset classes, how things perform for the first 6 months of the year. Generally speaking, very strong. In many ways, a reversal of a very challenging 2022.
Right.
So I'll start with U.S. stocks. really a range depending on the index, anywhere from up about 8% to up 17% for the S&P 500.
Yep.
International stocks, similarly, up pretty strong, up about anywhere from 5% to 12%, depending on the index. And then lastly, bonds. Bonds have done okay. The index is up about 2%. We're going to talk more about that in the bond section, where there's been some opportunities to earn more than 2%.
Yes.
Areas that we're pretty excited about.
Right.
So going back specifically to stocks, the S&P 500 up 17%.
Yeah, that's not annualized. That's just 6 months.
Yeah, so very strong performance. But that being said, when you really look under the surface, are stocks doing actually that well? Can you kind of talk about that a little bit?
Yeah, you hear a lot of words, the breadth of the market or narrow leadership. That's what's a lot in the headlines today. All that it means is that the top 10 stocks in the S&P 500 are the main drivers of return. You basically take those 10 out, and that accounts for about 82% of that 17% return.
So the other 490 stocks were kind of flattish to up small.
Flat up small, exactly. So not driving things. And if you look further at certain sectors, there are large sectors that were flat or negative on the year. So energy, financials, not surprising with the banks, as well as healthcare, were all flat or negative in terms of their performance.
One other similar interesting stat, dividend payers versus non-dividend payers. So those non-dividend payers, those companies that don't actually distribute cash flows or dividends, were up a strong 18%. Dividend payers, theoretically those healthier, strong companies that can actually distribute cash flow to investors, only up 4%.
Yeah.
So an interesting dichotomy between those two.
Quality not necessarily leading the charge.
Right.
And in a healthy market, you would like to see broader breadth, so everything going up to some degree. So this is potentially a much narrower, less healthy market because it's only being led by those handful of stocks.
So with this run up in stocks, let's now move on, talk about stock valuations. And I'm going to quickly remind the audience of what a PE ratio is, a price to earnings ratio. If a stock, let's say, has $1 of earnings, and you pay $10 for that stock, that's a 10 price to earnings ratio. If you paid $15, that'd be a 15 price to earnings ratio. The S&P 500 right now is trading on the expensive side at a 19 times price to earnings ratio. I'm going to quickly pull up a chart here that shows the Magnificent Seven, the 7 stocks that are topping the headlines. You recognize all these names here. And you could see the lowest PE ratio on this list, Google, is at 25 times. The highest, NVIDIA, and we'll talk about that a little bit shortly, 200 times price to sales. The average of these group of 7 stocks, a pretty eye-popping 78 times price. Excuse me, I said price to sales. I meant price to earnings ratio.
Yeah.
Really expensive valuations.
Yeah, and some people are looking back to the 90s, making comparisons to the 90s tech bubble. And it is an interesting data point to look at because thinking about the 90s, there were a lot of internet startups, companies that didn't have earnings or even revenue in some cases. People have said that's not the case now. These are great companies,
Yeah.
the Magnificent Seven. They're leading the charge. So that's true, and maybe they deserve a higher valuation than the broader market, but not quite to this extent. And so even looking back, though, in the 90s, you had companies that were good, solid companies who had similar overvaluation issues. I think Cisco is a great example because Cisco, great company,
Yep.
still a leader in its market today. But back then, at one point, it was the largest company in the S&P 500.
Yeah.
And what happened was when stocks came back down to earth, when the tech bubble burst, it went down over 90%. Fast forward to today, its revenue has grown about 3 times over this year.
It's a much larger company than it was in the late 90s.
Larger company.
In terms of sales.
In terms of its sales, right? So it's continuing to grow. Maybe it's not amazing growth, but solid growth over this period of time. And the company is still worth less than half of what it was at its peak. So if something gets that overvalued, it's just a really challenging investment. And so the number is, you were talking about price to earnings, so price to sales is another metric people look at. So forgetting what the company spends or whatever, what's the price just with its revenue? And so that got up to an eye-popping 40 times for Cisco.
40 times sales.
40 times sales.
So coincidentally, that is actually where NVIDIA is trading at right now, 40 times sales. So literally at the valuations that Cisco was trading in the late 1990s. And again, NVIDIA, great company, a growing company, probably very likely one of the beneficiaries of the AI movement.
Right.
Again, great company, no disputing that. But 40 times sales, I mean, just...
It's a crazy number. And I think it's tough sometimes. We live in these ratios all day long. So when we hear that, we're just, it's 40 times sales. It's
Right.
mind blowing. I think it is tougher for people who aren't living in math land to understand that. And so there's a great quote from another company that was one of the big beneficiaries of the tech boom, and then one of the ones that got nailed. So Sun Microsystems.
Yeah, they were a huge company in the late 90s as well.
Huge company, and their CEO, so they also had where they did great and completely blew up, with what happened in the 90s. And so their CEO in 2002 came out and had a quote that was talking about how crazy the prices got back then, and would have been more impressive, if he'd done it in the late 90s. But it was 2002, and he said at 10 times revenues, so the 10 times the price to sales, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders, who might not like that. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking?
I love that. What were you thinking? This is from the CEO of the company, and Sun Microsystems at the time, again, it was trading at 10 times sales,
Yes.
1/4 of what Cisco is trading at 40 times, or NVIDIA in the current environment at 40 times as well. So just really expensive valuations. So given these expensive valuations, what is our current approach with stocks? We continue to be underweight stocks, given, again, our concerns with valuations, and also specifically because we can generate, we believe, equity-like returns from other asset classes. And we'll be coming to that in a few minutes, things that we're very excited about. But all that being said, yes, we're underweight stocks, but we still take a diversified approach to stocks. So we're still going to have exposure to these larger names, the Apples, Microsofts of the world. We're just going to be underweight them in favor of more quality-focused companies that are trading at more reasonable valuations. So you want to shift gears now and talk about bonds, or maybe actually surprisingly a little bit more of an exciting asset class?
Well, we're excited about it, and it's the first time in a long time that bonds have been exciting. But just to give a quick recap, it has been, call it for about the last 18 months since the Fed started their rate rising cycle, when bonds started to look interesting. So you started to actually be able to get paid yield on bonds, which was nice. And the thing that we, I think, really embrace or like about bonds is that today, with rates where they are, you can make equity-like returns from a historical standpoint. So mid to high single-digit target returns for bonds and bond funds. And you're doing that, though, with contractual cash flows.
Yeah.
So this is something where you have it locked in and agreed to, you're going to get paid at this period. And so it just feels like there's a lot more downside protection as opposed to with the equity markets.
So going back to a few quarters ago, we've been excited about the return potential that you alluded to for bonds. So let's pull up a chart here quickly and review the performance of our actual bond portfolio. And this is showing our publicly traded mutual funds, not our private lending, which we'll get to in a second. But you can see here the index on the left up about 2% just for the first 6 months. All of our 8 underlying bond strategies outperform the index. The more conservative bond funds, those are the ones on the left. The range of returns are anything from the low 2s to call it a little over 4%. And then our more opportunistic bond funds up in the 3 to 5% range. And again, those aren't annualized numbers. That's just for 6 months of the year. So our bond funds have done really well. And keep in mind what happened last year in 2022. We really got out of the way of a very dangerous bond market. The index then was down 13%. And generally across the board, our bond funds did much better than that down 13% in 2022 as well. So both on the downside in 2022 and on the upside in 2023, we've really added a lot of value on the bond side.
So those are public bonds.
Yep.
Now we can do my favorite.
Your favorite?
Private lending.
Private lending. This is an asset class that we're obviously very passionate about, very experienced. We've been in this asset class really since the 2009, 2010 timeframe. And let's revisit the context that we're in. We alluded to the fact of regional banks with Silicon Valley Bank and Signature Bank shutting down. Regional banks have really retrenched. They're not lending as much as they used to. So how is this affecting the private lending landscape for us?
It's very positive, actually, for private lending. And what you're seeing is that competition from the banks, the regional banks especially, has just fallen off a cliff.
Yeah.
So a lot of these banks, even if they're not going under, they are retrenching, they're tightening their credit standards. It's a lot harder to get a bank loan. So the private lenders that are out there are finding that there are huge margins of safety in the loans they can do now. So that's in a lot of ways. One is they will lend less on a certain asset, property, or company, so they're gonna make a more conservative loan themselves. They're lending to higher quality borrowers in a lot of cases, so people who would have been easily bankable, prior to kind of all this bank tightening happening, and they are going to get usually a much higher rate as well. So it's something where there's a lot of cushion in a lot of different ways in the new loans that they can make, and so a pretty attractive environment for those lenders. Again, you come back to this concept of like, these are one of the reasons we love this. It's a contractual cash flow.
Right.
So we are looking at targeting, in this case with the private lending, it's more like high single digits or low double digits in this kind of environment. A lot of it's floating rate too. So if rates did keep going up, we potentially see that rise over time. But these are locked in terms of saying, okay, this is the price that you're going to pay me over this period of time. And if you don't pay me, I'm going to go get your stuff and I'm going to sell it to pay me. So that's the contractual nature of it. So it's unlike stocks where it's more of a popularity contest of like, what does everyone think this is worth and how high did it trade? Here we have it, pre-written how this is going to go. And again, you have a lot of cushion and safety and controls in the event that it doesn't go according to plan.
So not only is the return potential really exciting for us, the opportunity set is broadening.
Yes.
Whereas a lot of what we do is in the real estate space. In recent years, we've moved into lending in other areas, lending to companies, lending on assets. That's broadening as well, right? Because again, banks have left the building in a lot of ways. They're not lending like they used to. So our private lenders are coming in and filling that void, which is really wonderful. So we're really excited about the opportunities. We're broadening the work we do in this space and looking to provide more access for more opportunities.
Yes. So stay tuned.
Stay tuned.
More to come.
More to come. More to come. All right, so shifting gears to real estate. By real estate, I'm now talking about real estate equity or ownership of real estate. Top of mind are rising interest rates. How are we thinking about rising interest rates and how those might affect real estate values?
Yeah, and historically, rising interest rates are potentially challenging for real estate. You get the big thing being increased borrowing costs. So someone wants to go buy a property, it's going to cost a lot more when they go get their loan than it would have previously. And so that should put pressure on prices because now you're paying more. You need a lower price to make the math work basically on that purchase. So that should be the case. It really has not so far. So considering how quickly and aggressively interest rates have come up, real estate prices have softened somewhat, but really have not come down in a meaningful way. And we think that's really because there's a standoff between buyers and sellers. So you've got the buyers who are waiting for deals. They're sitting there waiting for their opportunities, and they're not coming yet. And then you've got the sellers who are going to hold on as long as they can and try not to sell into this market. They don't want to reset their expectations downward. I think a great example of that standoff is in the residential real estate market. I'm sure locally here, at least people are aware that there is just no supply of houses on the market. And it makes sense because you've got a bunch of people locked in at low rate mortgages that are holding on, and they look and they say even if they wanted to move, their payments would go through the roof. So they really don't have a choice. They're staying where they are for the time being. And then people looking for houses, they're going to be more desperate if they really need to move, and they're going to pay up if they have to. So it's a tough environment in that sense. Now, though, if you think about what's going to give with that and what's going to potentially be the catalyst that drives things forward here, it is interest rates. So it's what happens when certain people who had floating rate loans, when those loans reset upward, and so now they're forced to deal with this because their costs just went up. Or groups, especially on the commercial side, when they need to refinance. So their loan matures, they need to refinance. Now suddenly the bank says to them, look, I'll make you a loan, but it's going to be a lot lower than it was before. Now they've got to figure out what to do. They either can sell, or they could, if they have cash, they can put in cash, or they need to raise money, but they need to do something now. It's going to really prompt, I think, a lot more transactions.
So we and our real estate partners are very much on the lookout for those types of factors.
Yes, and I think luckily we're with partners who are in that mindset to be opportunistic, but also can be patient, because it's important now, I think, to be patient, not just kind of jump in, but when there are opportunities, we'll be ready to jump.
One sector of the real estate market that's very much in the news is the office market.
Yes.
Makes sense.
Lots of headlines.
Lots of headlines, and understandably so. COVID really changed the landscape for the office market, where people started working from home, vacancies have really spiked. So there's more volatility around the office market. I just wanted to hit on that very quickly. In terms of our office exposure across our various funds, very modest.
Yes.
And again, we're with real thoughtful partners who I think have a real disciplined approach with regards to how they purchase and invest in office. One simple example would be in one of our private lending funds, one of the office buildings that this private lending fund lends on, it's a medical office building.
A little different.
Little different. When you think about all flavors of office, medical office, much more resilient. Doctors tend to stay in the same location. Patients tend to keep coming back to that specific location. In this specific example, we're lending at a very low value, very low loan to value, 60% of the value of the property. So there's a big equity cushion there if something goes wrong. And lastly, the owner of that office building, the borrower in this case, he's worth several $100 million, and he signed personal guarantees on this loan. So when you add all of this up, a pretty resilient loan that's also earning a very high interest rate.
Yeah, so in that case, I wouldn't be scared of that loan just because it's related to office. There's obviously a lot of details that are around that. And so I think it's important to remember when you see the scary headlines about this asset class or that asset class getting hit, it's hard to paint real estate with a broad brush. It really needs to be a lot more local and specific, and the specific situation matters.
Right. We covered a lot today.
Yes.
A lot of unknowns. We talked about the unknown direction of the economy. Are we going into a recession or not? We covered the outlook with inflation. Again, lots of volatility around that. And a lot of unknowns across the various asset classes, especially when it comes to stocks. And I just want to acknowledge with all of this uncertainty out there, the emotions that can bubble up on the part of investors that can create a lot of anxiety, potential stress, and a feeling of a lack of control. And when most investors face these emotions, it's human instinct to try to regain control. And so how do most investors do that? It's through the power of prediction, and I'm putting power of prediction in quotes.
Yeah.
Most want to make a prediction of what is the market going to do over the next 12 months? Which direction is the economy headed? And then with that viewpoint, create an investment strategy that will align with that stance.
Yep.
That being said, we think that type of approach, a lot of misplaced energy.
Yeah.
Instead of that approach, we really embrace the uncertainty. We acknowledge that things can go in a variety of different directions. And once you take on that mindset, which we and our investment team really do, it completely changes yours and our investment approach. And instead of targeting specific asset classes that are going to do well in very defined outcomes, we look for a variety of asset classes that are just going to do better in a variety of different outcomes, no matter which way the economy or inflation turns.
And today, it's just exciting because the options are great.
They really are.
So you're getting paid really well to be more conservative.
Yeah.
So in the private lending space, even certain bond funds are targeting high single digits, low double digit type returns. Like, that's a great return for something that's a lot more conservative. Yeah. So that's the definition of risk management, right? You're finding opportunities where you're getting paid more at less risk. Risk management isn't hiding from risk. It's finding smarter risks to take.
In this higher interest rate environment, I mean, this is some of the most exciting hunting for new opportunities that we've ever had, or at the very least had in quite so many years. So with that, thank you everyone for watching.
Thank you.